Alright, now let's rewind the tape and explore the biggest fails in trading history. Because here's the ironic truth. Whether you're an everyday investor or a Wall Street pro, everyone wants to talk about winning. But nobody really wants to discuss the inevitable losers. Yet, the secret to consistent profits isn't about racking up wins. It's about minimizing losses. So, today, we'll peel back the layers of 5 colossal screw-ups that will keep you up at night. Mistake number 1. Jesse. Now let's start with a name you might recognize. Meet Jesse Livermore, often hailed as the greatest trader of all time. He lived a life straight out of a Hollywood movie. By the 1920s, Livermore was already a multi-millionaire. He navigated the roaring 20s, weathered the Great Depression, and emerged as a titan of the stock market. He predicted and profited from the market crashes of 1907, 1929, and 1938. In total, he made and lost 3 fortunes during his lifetime. That's like going to the casino and cashing out 3 jackpots only to lose them all. But the intriguing part is that he didn't lose his fortunes in the stock market, but rather outside of it through bad investments and an extravagant lifestyle. He lost big chunks of his wealth due to excessive drinking, gambling, and failed relationships. So who really took Livermore down? Was it the unpredictable nature of the market or his own personal demons? Well, both, actually. Livermore taught us that the market isn't your biggest enemy. Your emotions are. If you can't control fear and greed, no strategy will save you. Mistake number 2. Long-term capital management. Moving on. Let's dissect the collapse of long-term capital management, or LT, established in 1990 by a group of renowned economists, including several Nobel laureates. LTCM aimed to revolutionize finance by harnessing the power of math and computer models to predict market movements. Their strategy was based on exploiting minute price discrepancies in various markets. They borrowed heavily to amplify their returns, aiming to generate steady profits by capitalizing on these minor price differences. For instance, if a bond was slightly cheaper in one market compared to another, they would buy it in the cheaper market and simultaneously sell a nearly identical bond in the more expensive market, effectively locking in a risk-free profit. Sounds brilliant, right? Well, for a while it was. By 1996, their assets under management ballooned to $100 billion. However, their downfall began in the late 1990s when the Russian ruble collapsed and the value of emerging market bonds plummeted. These events shook the financial world and served as an eye-opener, demonstrating the unpredictability of global markets. Despite this, LTCM pressed on, doubling down on risky investments in Asian markets. As the economic crisis deepened, their losses spiraled out of control. By October 1998, they had lost $4.6 billion in just 2 months. This catastrophic loss led to the near collapse of LT. To prevent a systemic crisis, a group of 14 banks orchestrated a bailout, injecting emergency funds into the struggling firm. Long-term capital management serves as a cautionary tale. No matter how brilliant your strategy or how many experts are behind it, the market has a way of humbling even the best. Overconfidence can be fatal. Mistake 3. The 2008 housing crash. Alright, let's shift our focus to the 2008 housing crash. Imagine being so confident in a market's growth that you believe it can never crash. That was the prevailing sentiment in the years leading up to 2008. The housing market was on an upward trajectory, and everyone was convinced that real estate values would continue to soar indefinitely. Banks encouraged people to take out large mortgages, knowing that if the housing market did cool down, those properties could easily be sold for a quick profit. But greed, as they say, piled onto greed. Investors started buying up properties not because they intended to live there, but solely as speculative investments. They saw property values skyrocketing and assumed that this trend would last forever. But you know what they say? What goes up must come down. The market eventually reached a saturation point and prices began to stabilize. But by that time, too many people were invested in the market, and when the bubble burst, trillions of dollars vanished overnight. The world watched in suspense as the housing market collapsed and the global economy teetered on the brink of collapse. It was the worst financial crisis since the Great Depression. Now, why does this story matter to you? Because it underscores a simple yet profound truth. No matter how invincible you feel in the market, always remember to respect the power of risk. Leverage is a double-edged sword. It can make you rich quickly, but it can also destroy you faster than you can imagine. If you want to see the next 2 biggest mistakes traders have ever made, click here. And if you got some value out of this video, smash the like button and subscribe. It helps my channel tremendously. And I'll see you back here tomorrow.